Good morning, and welcome to the Bulls, Bears, and the Bell Morning Edition. Thank you for joining us. Okay, today we're diving deep into Monday, November 10th, 2025, and really the whole critical week ahead. Our mission, if you will, is to tackle this really jarring contradiction in the market right now. We're seeing this huge, almost euphoric rally across the board at the macro level, but at the same time, individual companies, if they show even the slightest flaw, they're getting punished. Swiftly, brutally. It's like the market is running on massive hope and extreme fear all at once.
It's a fascinating setup, and that rally you mentioned, it's really fundamentally a political event, maybe a technical one too. A release of pressure. It's a sharp snapback driven by the hope, the expectation that this record 41-day government shutdown is finally ending. That's letting some of that valuation panic from last week, especially in tech, unwind. We're celebrating the potential end of uncertainty, not some flood of great economic data. Actually, you could argue we're celebrating because we're kind of blind to the data right now.
Okay, right. Let's unpack that relief rally first then, because the screens are definitely green this morning. What was the specific catalyst? What flipped the switch?
It happened late Sunday down in Washington. The Senate moved forward on a key procedural measure. And crucially, it had strong bipartisan support, got that 60-vote threshold needed to actually pass things. So the market sees that not just as talk, but as real legislative action towards reopening the government.
That 60-vote number is so important, isn't it? For you listening, that means it's not just posturing. It signals there's enough agreement to actually get legislation passed this week. That's why the market's treating it like a genuine, all-clear signal, right?
Precisely. And you see the scale of this rebound because, well, last week was pretty painful. Remember, the NASDAQ composite dropped 3%.
Yeah, it's worst week in like 7 months.
Exactly.
Right.
And the S&P 500 fell 1.6%, the Dow 1.2%. So today is really just unwinding that dual anxiety, the political mess, and those inflated tech valuations people were worried about.
And you can see that unwinding play out on the futures dashboard. Looks like a strong risk-on appetite, especially for growth.
Oh, absolutely. The NASDAQ 100 futures are way out front, leading the charge. A significant reversal there. S&P 500 futures are up strong too, yeah. But look at the Dow Jones futures. They're positive, sure, but definitely lagging behind the big tech indexes. That tells you right away capital is rushing back into those growth names that got hammered last week. It's a tech-led recovery, clear as day.
And it's not just stocks, right? This return to maybe more speculative buying, it's showing up across asset classes. Classic rotation.
It is. You see Treasury yields ticking up a bit. That's classic capital moving out of safe government bonds and into, well, riskier things. And maybe the clearest sign of relief is the VIX, the fear gauge. It's down sharply, dropped nearly 7% last check.
Wow. Great.
Yeah, it confirms that immediate sort of systemic worry tied to the shutdown. It's just evaporated for now. And you're seeing global markets, like the German DAX, reflecting that same bullishness.
Okay, so that's the macro story. Political relief, hope driving things. But here's where it gets tricky analytically, because the micro story is just brutal, unforgiving fear. And we've got two perfect examples today showing that huge gap. Treehouse Foods, saved by M&A, versus Monday.com, just destroyed by its guidance.
Yeah, let's start with the one that really shows the sheer power of an acquisition price. Treehouse Foods, ticker THS.
Right. THS shares are just soaring this morning, up over 21% last I looked. You'd see that and think, wow, their business must be firing on all cylinders.
Quite the opposite, actually, operationally. Their Q3 report was, well, a disaster might not be too strong a word. They reported a huge GAAP net loss, over $265 million. And most of that was driven by a goodwill impairment charge of nearly $290 million.
Whoa, hold on. Let's clarify that. Goodwill impairment. That's basically the company saying, hey, that company we bought a while back and paid a premium for.
Yeah.
It's not worth that much anymore.
Right.
Hits the bottom line hard.
Exactly right. It's a sign of, well, a serious misstep somewhere along the way. So the fundamentals looked awful, yet the stock is flying. Why? Because they announced they're being acquired. Invest Industrial's buying them for $2.9 billion. The cash per share. Plus this other thing called a contingent value, right? It offers such a big premium. It just completely papers over the terrible operating results. The buyer's price is the value now, not the current profit and loss.
M&A provides the ultimate safety net there.
Okay,
now let's flip to Monday.com. Ticker MNDDAY. Why? No safety net there. Just a sheer cliff.
This is such a perfect, painful lesson in how high-growth stocks get valued. MNDY is in a total tailspin this morning. It's crashed, 15% to 20%, hitting a new 52-week low.
And this is the part that's hard to wrap your head around. They beat expectations for Q3. EPS, revenue, both came in comfortably ahead of what analysts predicted. So why the absolute collapse?
It is 100% about the Q4 revenue guidance. Management guided for $328 million to $330 million. The analyst consensus was closer to $334 million. Let's call it $333.8 million. So they missed the average analyst guess by, a tiny fraction. A couple $1 million on over $300 million.
A fractional miss causes a 20% stock crash.
Yeah.
That seems incredibly punitive. Why? No benefit of the doubt. Especially when they just crushed Q3. Could they just be guiding conservatively, sandbagging?
Normally, maybe, but not when a company is valued at, say, 20 or 30 times forward sales, which MNDY basically was. The market has zero patience for potential sandbagging at those levels. For these kinds of hyper-growth names, honestly, the past performance is almost irrelevant. The entire valuation, that huge multiple, it's built on the future growth path. So even a fractional miss in the next quarter's guidance, however small, it's seen as a crack in the foundation, a signal of deceleration. It basically tells the market, hey, that 5-year runway of perfect 40% growth we assumed, maybe it's shorter or maybe it's not as steep as we thought.
Huh. It's like you priced a rocket based on it getting to Mars, and then you see a tiny dip in acceleration today. Suddenly, the whole assumption about even reaching orbit, let alone Mars, gets questioned.
That's exactly the mechanism. It triggers this massive, instant, punitive re-rating of the stock. Investors just bail, recalculating the value based on a new, slower growth model.
And if we connect this micro-level fear back to the macro hope we started with, you can see that unwinding theme confirmed, right, in the sharp bounce back of those beaten-down AI names.
Precisely. Look at Palantir, Micron, NVIDIA, all posting really strong gains this morning. These moves aren't driven by their own earnings today. It's just capital flowing back in now that the political all clear seems to be sounding. It's unwinding that valuation panic that really dominated things last week.
We also saw one M&A deal that kind of put a lid on the excitement, didn't we? MedSera, MTSR.
Yeah, MTSR is down about 15% this morning. And that's after Pfizer announced they're buying them for a reported $10 billion. It's not that it was a bad deal for Metsera. It's because the other potential bidder, Novo Nordisk, apparently dropped out. So the stock had this big speculation premium built into it, assuming this drawn-out bidding war. Once the option was over, poof, that premium vanished. The stock fell back towards the actual deal price. Kind of confirms the peak speculation passed.
Okay, so this clash, macro hope, micro fear, sets up a really interesting week. And it's made even more complicated by the biggest problem we have systemically right now, this economic data vacuum.
This is the real headwind, isn't it? That 41-day shutdown basically broke the economic calendar. Government agencies, they just can't release the key reports on schedule, which means the market, and maybe more importantly, the Federal Reserve, they're essentially operating in the dark.
And we're not just missing, minor reports. We're missing the big ones, the key signals the Fed uses to figure out if the economy is too hot or too cold.
Absolutely. The October Consumer Price Index, CPI, plus the Producer Price Index, PPI, and retail sales. All were scheduled for this week, November 13th, 14th. They're almost certainly delayed now. Without that core inflation data, without the consumer spending numbers, the Fed is just flying blind. They can't really justify their whole data-driven policy approach. It's like trying to steer a ship across the Atlantic and realizing halfway through someone stole your GPS and all the charts.
So what does that mean for us, for investors right now?
Well, it totally flips the script on how we analyze things. We saw it last week already. When the official data goes missing, every other piece of information gets magnified. The market's forced to treat these secondary reports, these private sector surveys, as primary indicators. Because, well, what else is there?
Okay, so we need to know what is actually coming out this week that we have to treat as a primary signal now, starting with Tuesday.
Right. Tuesday is Veterans Day. Bit of a logistical quirk. The U.S. stock market is open, but the bond market is closed. The key data point is the NFIB Small Business Optimism Index. Normally important, but this week, critical. Because we don't have the official inflation or jobs reports, we have to really dig into the NFIB subcomponents. Things like price-raising plans or hiring intentions. They become our best proxy for inflation pressure and labor health.
And then Wednesday, lots of Fed officials are speaking. Given they're flying blind, every word is going to be dissected, I imagine.
It really will be. We've got several heavy hitters, Williams, Waller, Bostic, Collins. The focus won't be so much on what they think the missing data says, because they don't know. It'll be more about how they're coping with having no core data. How are they making decisions? What's their fallback plan? The market needs reassurance there.
And then Friday, we get maybe the cleanest look at the U.S. consumer possible in this data vacuum.
That's right. The University of Michigan Consumer Sentiment Survey, the preliminary read for November. With official retail sales data likely delayed, this sentiment report becomes probably the week's most crucial proxy for consumer health and confidence. If that number misses badly, it could really cool off today's macro optimism in a hurry.
So we're in this weird spot where the usual hierarchy of data is completely flipped. For this week, anyway, it feels like earnings reports have become the new macro indicators.
That's the perfect way to put it. Usually we judge company results against the economic backdrop. This week, we're going to use company commentary to try and judge the economy itself. The earnings calendar isn't super heavy, but the reports we do get become disproportionately important. We're all just searching for signals.
All right, let's flag the key reports we should watch as these economic proxies, starting tonight, Monday, after the bell closes.
Tonight, definitely keep a close eye on CoreWeave, ticker CRWV. Think of this as our crucial AI proxy for the week. After last week's tech turbulence and today's big rebound, CoreWeave, they're a key player in AI data centers and cloud infrastructure. They'll give us the first real validation point. Is that underlying AI demand still strong? Are revenues holding up? A good report supports today's rally. Any sign of weakness? It could easily reignite those valuation fears from last week.
Looking further out, Wednesday gives us a proxy for business spending, right?
That'll be Cisco Systems, CSCO, reporting Wednesday after market close. The market's going to treat this as the main indicator for enterprise spending for network demand. It gives us a window into whether businesses are starting to pull back on big infrastructure projects because of all this political and economic uncertainty.
And for the consumer, our best insight might actually come from Mickey Mouse.
Heh, basically yes. The Walt Disney Company, DIS, reports Thursday before the market opens. With no official retail sales data, everyone's going to zoom in on Disney's results. Specifically, things like theme park attendance, streaming profits or losses. That becomes our cleanest read on discretionary spending and whether people are still willing to shell out for experiences.
And finally, another key piece of the tech puzzle reports Thursday.
Applied Materials, AMAT, reporting Thursday after the close. Another vital semi and AI proxy, their guidance on spending for chip-making equipment. That gives us immediate insight. Are the big chip companies still investing like crazy to build out AI capacity, or are they starting to tap the brakes because they're worried about a recession?
Okay, so let's try and synthesize this really contradictory picture we're seeing today. We've got the political all-clear driving this technical macro rally. But underneath, the micro picture, like that MNDY collapse shows, there's just extreme fear about future growth. Very little tolerance for error.
Absolutely. The rally feels technical, it feels political, but the real danger, I think, is that the market is celebrating the end of uncertainty. But it might be dangerously ignoring the economic damage that's already been done. We saw those private surveys before the shutdown deal showing consumer sentiment crashing back to 2022 lows. Layoff reports were picking up. Today's celebration, it kind of lacks fundamental data support, doesn't it?
Which leaves us with that really provocative question for you, the listener, as you watch things unfold this week. If and when the government actually reopens and those delayed CPI and retail sales reports finally hit the tape, will today's optimism hold up against the real economic cost of that 41-day shutdown? Or will that delayed data trigger the kind of sudden, harsh risk-off shock that this current rally seems to be completely ignoring?
That eventual data drop, whenever it comes, that's going to be the real test for this market's resilience. Definitely track that release schedule closely when it firms up.
Thank you for joining us for this deep dive into these clashing market dynamics on November 10th. We'll be right here tracking all those proxies with you through this critical week. Have a profitable day.